Who doesn't like to make a profit on one's investments? But when you sell an investment at a gain, you also have to pay tax as per the rules. Now, for many investors, decoding these rules is more painful than paying the tax itself. And when you realize that you're getting a hang of the tax rules, they change. Now, something similar happened in the Union Budget for FY25, which has overhauled the entire capital gains taxation. So, the tax rules governing all investments, mutual funds, stocks, real estate, bonds, etc. have changed. For investors, this means the cycle of unlearning and relearning has started yet again. But don't worry. In this video, we will untangle the new capital gains rules for you in the simplest manner possible. We will cover all asset classes so you don't have to go anywhere else to understand the revised capital gains tax rules. Hello and welcome to ET Money's YouTube channel. This is going to be among the most important videos for you as an investor, so do watch it till the end. That will not only help you understand the changes in taxation, but also know how to optimize it going ahead. But before I start, let me ask you to subscribe to this channel if you aren't already a subscriber. And don't miss to press the bell icon so you never miss a video from us. Okay, so we have divided this video across types of investments. Now you can either watch this video from start to finish or jump to any specific type of investment you are interested in by clicking on the timestamp link in the description. Alright, let's begin with first taking a look at the broad changes in the capital gains taxation that the Budget 2024 made. First, for simplicity, the budget has proposed just two holding periods, 12 months and 24 months, for figuring whether the capital gains is short-term or long-term. For all listed securities, it's proposed to be 12 months, and for all other assets, it will be 24 months. Second, the rate of short-term capital gains tax for STT paid equity shares, unit of equity-oriented mutual funds, and units of business trusts, that is REITs and InvITs, has been increased from 15% to 20%. Now, STT stands for Securities Transaction Tax. It's a levy you pay while investing in stocks listed on Indian exchanges. Now, the stated reason for this change in tax rate is that the existing rate of 15% was too low, and the benefits of this low rate were flowing largely to high net worth individuals. Other short-term capital gains will continue to be taxed at the applicable rate. Third, the rate of long-term capital gains is proposed to be 12.5% for all categories of assets. Earlier, this rate was 10% for STT paid equity shares, equity-oriented mutual funds, and business trusts, and 20% with indexation for many other assets. Fourth, the limit of tax exemption of long-term capital gains of up to 1 lakh has been increased to 1.25 lakh. Now, do note that this tax exemption of 1.25 lakh on long-term capital gains is applicable only in the case of equity shares where Securities Transaction Tax or STT has been paid, on equity-oriented mutual funds and business trusts, that is REITs and InvITs. It is not available for other types of long-term capital assets. Fifth, given the rationalization of long-term capital gains tax to 12.5%, the indexation benefit applicable for certain assets has been removed. Now, the stated reason for this move is that it will ease the computation of capital gains for the taxpayer and the tax administration. Sixth, there will be parity in taxation between resident and non-resident assessees. And seventh, all these proposals will come into effect from 23rd July, that is the budget day. Now, the budget also corrected an inadvertent oversight in 2003 when returns from debt-oriented funds were made taxable at the tax slab irrespective of the holding period. Now, at that time, debt-oriented mutual funds were defined as those that invested less than 35% in domestic equity. The requirement of investing not more than 35% of assets in domestic equity shares also inadvertently impacted many other funds that weren't debt-oriented but invested less than 35% in domestic equity shares. This included gold funds and ETFs, international funds, and funds of funds that invested in other assets. Going forward, those funds that invest at least 65% of their assets in debt and money market instruments will be considered as debt oriented for tax purposes. This category will also include such funds that in turn invest in a fund that has at least 65% exposure to debt instruments. Now, these were the major capital gains related announcements. Alright, let's see in detail now how they have impacted your investments. Equity funds are those that have at least 65% of their assets invested in Indian equities or stocks. Now, before the budget, if you sold an equity fund before 12 months of buying it, you had to pay the short-term capital gain tax of 15%. If you sold it at a gain after 12 months of holding it, you had to pay the long-term capital gains tax of 10%, but beyond 1 lakh of gains. Now, there is no change in these periods, but the tax rates have been revised upwards now. Your short-term capital gains will now be taxed at 20% in place of 15%, and your long-term capital gains will now be taxed at 12.5% in place of 10%. Now, as a small relief, long-term capital gains up to 1.25 lakh in a financial year will be exempt from tax. So, the 12.5% tax will be applicable on the gains over and above the 1.25 lakh limit. So, here is how equity funds will be taxed now. Quite obviously, the tax on short-term and long-term capital gains has increased here, and that's bad news for investors. Now, the rise in exemption limit may have been meant to be a balm, but it remains to be seen how far it goes in soothing investors' pain. Alright, now let's talk about debt funds. Debt funds are those whose debt exposure to debt and money market instruments is at least 65% of assets. Now, in the budget for FY24, the gains from debt funds were made taxable at the applicable slab rate irrespective of the holding period. However, this rule applied to those debt funds bought on or after 1st April 2023. So, the taxation of your debt fund will now depend on whether it was bought before or after 1st April 2023. Let's first talk about debt funds you bought after 1st April 2023. So here, it's quite simple. No matter how long you hold these debt funds, you will be taxed at the slab rate. Now, if you purchase your debt fund before 1st April 2023, your tax will now depend on when you sell or have sold your debt funds. If you have sold it between 1st April 2023 and 22nd July 2024, that is before the budget day, you will be subject to the old tax rules related to debt funds. Now, as per these rules, if you held your debt fund for 36 months or longer, you had to pay 20% tax on the gains post indexation. And if you sold before 36 months, the gains would be added to your income and taxed as per the slab rate. Now, indexation adjusts your gains against inflation and hence helps lower the tax. So, if you sold your debt fund after 36 months between 1st April 2023 and 22nd July 2024, you can consider yourself lucky. Now, if you sell a debt fund bought before 1st April 2023 now, that is anytime on or after 23rd July 2024, the budget day, you will be subject to tax of 12.5% if the holding period is 24 months or more. And if the holding period is less than 24 months, the gains will be added to your income and taxed as per the slab rate. Do know that you won't get any indexation benefit now, even if your purchase date is before 1st April 2023. So, while the reduction in tax rate and holding period is good, the loss of indexation can adversely affect your post-tax gains depending on your individual case. Alright, let's now talk about the changes in taxation of hybrid funds. Now, hybrid funds can be divided into three categories. There can be equity oriented, where the equity exposure is at least 65%, or they can be debt oriented, where the debt exposure is at least 65%, or they can have an equity exposure of more than 35% but less than 65%. Equity oriented hybrid funds will be taxed like equity funds. This is applicable for aggressive hybrid funds, dynamic asset allocation funds, arbitrage funds, and equity savings funds. You can jump back to the equity funds part of this video to understand their taxation. With these funds, you are also eligible for the 1.25 lakh exemption on long-term capital gains. Now, debt-oriented hybrid funds will be taxed like debt funds. This is applicable for conservative hybrid funds. Now, you can jump back to the debt funds part of this video to understand their taxation. Now, those that have an equity exposure of more than 35% but less than 65% will be taxed depending upon when they are sold. Now, this category constitutes multi-asset allocation and balanced hybrid funds. Now, if they were sold between 1st April 2023 and 22nd July 2024, they are eligible for the indexation benefit if you had held them for 36 months or more. For periods less than 36 months, the gains will be taxed as per your tax slab. But if they are sold on or after 23rd July 2024, that is the budget day, they will be subject to revised taxation rules. For holding periods of less than 24 months, the gains will be taxed as per their slab rate. And for periods above 24 months, the gains will be taxed at 12.5%. The indexation benefit will be gone. So, while the reduction in holding period and tax rate is welcome, the removal of indexation benefit can hurt your post-tax returns depending on your individual case. Alright, let's now see the taxation on other type of mutual funds. Other type of mutual funds and ETFs such as gold funds, silver funds, international equity funds, international FOFs, etc. have been taxed like debt funds. This was an anomaly that this year's budget has sought to remove, but this has made their taxation more complicated now. Let's see how. Because taxation of debt funds changed in the 2023 budget, the taxation of these other types of mutual funds would also depend on whether you bought them before or after 1st April 2023. Now, if you bought them after 1st April 2023 and if you sell them before 1st April 2025, then no matter what the holding period, the gains from these funds will be taxed at the slab rate. But starting 1st April 2025, that is from the next financial year, these fund categories will qualify for the revised long-term capital gains taxation if they are held for more than 24 months. And for periods less than 24 months, they will be taxed at the slab rate. So from 1st April 2025, selling these funds will be more beneficial for investors as the tax rate will be significantly less than the 20% or 30% slab rate. Now this budget provision has put these funds in the limelight and they have emerged as a winner amid the taxation overhaul. But if you purchase these funds before 1st April 2023, your tax treatment would depend on when you sold them or will sell them. If you sold them between 1st April 2023 and 22nd July 2024, that is before the budget day, you would get the old tax treatment. That means if your holding period is less than 36 months, your gains would be taxed at the slab rate. But if your holding period is more than 36 months, your gains would be taxed at 20% but after indexation. However, if you sell these funds on or after 23rd July, that is the budget day, your tax treatment would be the same as we saw a little earlier. So if your holding period is less than 24 months, your gains will be taxed as per your slab. Otherwise, they'll be taxed at 12.5%. So for this bracket, while the holding period and the tax rate has reduced, you have also lost the indexation benefit. This can result in lower post-tax returns depending upon individual case. So this was the tax treatment of mutual funds. Let's now see how the taxation of stock returns has changed now. As you may have guessed, returns from stocks have the same taxation as that for equity funds. And like equity funds, there will be a tax exemption of 1.25 lakh on long-term capital gains. But this tax treatment is only for listed stocks. If you invested in unlisted stocks, the tax treatment is different. Now, if you sell unlisted stocks before 24 months of holding them, the gains will be added to your income and taxed as per the slab rate. And if you sell them after 24 months, you will have to pay a tax of 12.5% on the gains. Do note that there is no exemption of capital gains of 1.25 lakh here, as unlisted stocks don't qualify for that. Now, earlier if the holding period for the unlisted stocks was more than 24 months, they would be taxed at 20% post-indexation. So while the tax rate has reduced now, the indexation benefit is gone. Depending upon your individual case, that could be good or bad. Now, there is no change in the taxation of short-term capital gains from unlisted stocks. Earlier also, if you sold unlisted stocks before 24 months, the gains would be taxed as per the slab rate. These rules will also apply to those investing in foreign stocks, such as those listed in the US, as their tax treatment is like that of unlisted stocks. Now, apart from these, if you trade in futures and options, the securities transaction tax or STT on them has been raised to supposedly cool down the market activity and reduce the participation of retail investors in the risky F&O segment. For futures, the STT has been raised to 0.02% from 0.0125%. For options, it has been raised to 0.1% from 0.0625%. This change will come to effect from 1st October 2024. And not just this, starting 1st October, buybacks have also been made taxable in the hands of the recipients like dividends. So, the buyback proceeds will be taxed as per your slab rate. Now, currently, companies pay tax on conducting buybacks, and gains from buybacks are tax-free for investors. Do know that it's not the net gains from buybacks that will be taxed, but the full buyback amount. The cost of acquisition of shares will be treated as capital loss and can be adjusted against capital gains or carried forward. Let's see this with an example. Let's say you purchase 100 shares of a company at 100 rupees per share. So your total investment is 10,000 rupees. The company bought back 20 of your shares at 120 rupees per share. So you got 2400 for this buyback. Now this entire sum of 2400 will be taxed as dividend as per your slab rate. Now the cost of acquisition of these 20 shares, that is 2000, will be set off as a capital loss gain against your capital gains or carried forward. Now this has been done to stop companies from resorting to buybacks in place of paying dividends. For promoters, dividends would be taxed at the highest slab rate, but for companies, the effective tax rate on buybacks is 23.296%. So buybacks might have acted as a tool for tax arbitrage. So in the future, it's likely that the number of buybacks will fall and companies will resort to buybacks only when the share price is really at a bargain. Let's now talk about the change in taxation of real estate. From 23rd July 2024, selling real estate properties entails a tax of 12.5% if the holding period is 24 months or more. For periods less than that, the gains are taxed at the slab rate. We have discussed the taxation of gold funds and ETFs in the section on the taxation of other mutual funds. So if you're looking for that, you can click on the timestamp in the description and jump to that section. Here, we will talk about the taxation of physical gold. If you hold it for less than 24 months, the gains will be taxed as per your applicable slab rate. For periods of more than 24 months, the tax stands at 12.5%. Earlier, if you held physical gold for 36 months or more, the applicable tax was 20% post-indexation. So, in the revised structure, while the tax has been reduced, the indexation benefit is gone. Now, this can result in paying more or less tax than before depending upon your individual case. This taxation regime applies for physical silver as well. Now, another provision in the budget that directly impacts gold and silver prices is a cut in the custom duty from 15% to just 6%. That's a massive drop of 9 percentage points. Let's now talk about the taxation of bonds. If you hold a bond, its taxation now will depend on whether it's listed or unlisted. In the case of listed bonds and debentures, the holding period to qualify for long-term taxation of 12.5% is 12 months. However, in the case of unlisted bonds, no matter what the holding period, the tax is at the applicable slab rate. Now, this marks a major push towards investing in listed bonds and debentures as compared to unlisted bonds. Earlier, bonds and debentures were to be held for 36 months to qualify for long-term taxation, which was 20% without indexation. Let's now see the taxation of REITs and InvITs. REITs or real estate investment trusts and InvITs or infrastructure investment trusts are business trusts. The tax on the sale of these instruments now depends on whether they are listed or not. For listed REITs and InvITs, the taxation is like that of stocks. Like stocks, you can also claim an exemption of 1.25 lakh on long-term capital gains. But in the case of unlisted REITs and InvITs, this exemption is not applicable. Further, the holding period has to be at least 24 months for such REITs and InvITs to qualify as long-term investments. Earlier, listed REITs and InvITs had to be held for 36 months to qualify for long-term capital gains tax rate of 10% beyond 1 lakh. This holding period has been drastically reduced now. So, these were some major investment avenues and how their taxation has changed post-budget. Though we have undertaken adequate rigor while researching for this video, I would still encourage you to do your own research as well to better understand the change in taxation post the budget. If required, consult a tax advisor. And because the tax space is ever evolving and is open to interpretation, do keep an eye on future developments. With this, we have come to the end of this video. I hope you found this video useful. If you did, please don't forget to share it with your friends and family and help us reach more people. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.